Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 1st, and today we're tracking 3 things that can move your money fast. A big call for Fed rate cuts, a chip policy headline tied to China, and a volatility jolt in gold and silver.
Happy New Year! My resolution is to stop checking futures before coffee. I will fail by 9:01 a.m. Also, can we do rate cuts first? Because my mortgage wants a motivational speaker.
Story 1. Economist Mark Zandi says the Fed could surprise with 3 rate cuts in the first half of 2026, while markets and even Fed officials have leaned toward only modest easing. Translation: someone's calling for a faster pivot than the consensus.
3 cuts in 6 months is like saying, I'll start meal prep and training for a marathon on Monday. Possible, but what has to happen for the Fed to actually do it?
The simple finance behind it. The Fed cuts rates when inflation is convincingly cooling and/or the job market is weakening enough that keeping rates high would risk a bigger slowdown. Think of rates like a thermostat. Cuts mean the room is getting too cold, or you're confident the heat won't run away again.
So if inflation behaves and jobs get a little wobbly, the Fed goes from strict parent to, fine, one more episode. But what does this mean for normal people, besides my group chat screaming about refinance calculators?
If cuts come faster, borrowing costs typically drift down. Mortgages, auto loans, business credit, though not one for one. Savings yields can fall too, which matters if you've been enjoying high cash rates. And markets. Rate cuts often support stocks and longer-term bonds, but the reason for cuts matters. Cuts because growth is fine is different from cuts because something broke.
Ah yes, the 2 flavors, soft landing sorbet versus recession stew. Actionable question. What's the grown-up move if you're a middle-class investor trying not to get whiplash?
A practical checklist. 1. Match cash to near-term needs. Don't chase yield with emergency money. 2. If you hold bonds, understand duration. Longer duration bonds tend to benefit more if rates fall, but they swing more. 3. Avoid betting everything on a single path. Consider a balanced mix rather than an all-in, cuts-are-coming trade.
Okay, story 2. Chips. I saw the headline about the U.S. granting TSMC an annual license to import American chip-making tools into China. That sounds like yes, but with paperwork. Why should investors care?
What happened? The U.S. government granted TSMC an annual license to import U.S. chip manufacturing equipment to its fab in Nanjing, and TSMC said it helps ensure uninterrupted operations and deliveries. Reuters also noted Samsung Electronics and SK Hynix have received similar arrangements.
So the world's most important kitchen gets to keep buying ovens, but only on a renewable permission slip. That's comforting and terrifying at the same time.
The simple finance behind it? Semiconductors are a supply chain industry with long lead times. If a fab can't get tools or parts, output drops, customers get delayed, and revenue gets messy. Licenses reduce policy risk premium, that extra discount investors apply when rules might suddenly change.
Policy risk premium is the market's way of saying, I don't trust the vibes. For normal people, does this touch our lives beyond iPhone availability and the price of anything with a screen?
It can. Stable chip supply supports everything from cars to appliances, and it reduces the odds of sudden price spikes. For investors, it's also a reminder. Geopolitics is now a core factor in tech earnings. A useful action? Stress test your portfolio. If you're concentrated in semis or mega-cap tech, ask what happens if export rules tighten again.
Story 3. Gold and silver fell after CME raised precious metals margins. Again. I need you to explain margin like I'm a responsible adult who still hates math.
What happened? After a strong year for precious metals, CME raised margin requirements. Margin is the good faith deposit traders must post to hold futures positions. When the exchange raises margin, some traders must add cash or reduce positions, often by selling, so prices can dip even if the long-term story hasn't changed.
So it's like the venue suddenly doubles the cover charge, and half the crowd leaves. Then everyone's shocked the dance floor is emptier. Who gets hurt here? Day traders, long-term investors, or both?
Mostly leveraged traders feel it first, because leverage is sensitive to margin. Long-term holders can see volatility spill over into ETFs and spot prices. But the key lesson is risk management. If you're using leverage, options, futures, margin, know that rules can change quickly when volatility rises.
Today's vibe is the Fed might get friendlier. Chips are still geopolitics with a quarterly earnings report, and metals just got a pay more to play sign. That's a lot for one breakfast.
Quick recap. Watch the data that could justify faster Fed cuts, track policy signals that change semiconductor supply expectations, and remember that margin hikes can create sudden commodity sell-offs. If this helped, subscribe and share the episode with someone building their 2026 plan. See you next time on BD Daily Finance News Podcast.